Welcome to Investment Insights, a series where ETF Stream and its partners analyse some of the key investment trends across ETFs. For this interview, we partner with STOXX to take a deep dive into European equities, discussing the outlook for markets, how investors are positioning, and the latest innovation in the indexing space. To discuss this, I'm delighted to be joined by Aaron Singhal, Managing Director and Global Head of Product Management at STOXX, Vincent Donaceau, Head of Investment Strategy at Mundi ETF, Index and Smart Beta, and Karim Chadid, Head of EMEA Investment Strategy at BlackRock. So let's jump straight into it. Aaron, coming to you first, how should investors think about European equity allocation?
Yeah, I think the first thing to step back is to look at flows into the markets. We've seen several years of headwinds within the European market in terms of allocation for geopolitical reasons, valuation reasons, multiple reasons. When we look at the flows year to date, it's amazing to see close to $80 billion in net new flows within U.S. core equities within the index space versus by the ETF vehicle. A lot of headwinds in European equity ETFs leading up to this date, but we've seen that reversal this year. Just within the Euro STOXX 50 and the STOXX 600, we've seen $3.5 billion of net new assets flow in. We'll talk about it later in the session, but a lot of tailwinds behind that, whether that be valuations or that be market dynamics.
Excellent stuff. And Karim, coming to you, how should investors think about their European equity allocations?
Echoing Aaron, of course, to add a bit more color to the flows that we've seen in the ETF industry, this has been a strong year. $12 billion or so have gone into European equity ETFs year to date. But also under the hood, I think what's interesting is that 25% of those flows have come from US investors. So it's not just home bias. And the money has been sticky. So despite the volatility in politics in June, for instance, the flows continue to come in. So there's a broader positive story on the market here at play. But then also thinking about the allocation, I think selectivity is key. So we like to look at European equities from a bit more of a bottom-up precision approach, focused on which sectors to look at with a focus on quality tilted sectors.
Great stuff. And Vincent, what would you add there in terms of European equity allocation, how you approach?
Yeah, just echoing what Karim and Arun just said, I would say it's with regard to UCITS ETF in Europe, 2024 is a record year so far. And within this 102 billion of net new assets, equities, Europe equities are still a reasonably small part, 7 billion. But clearly, we noticed in Q2 a shifting sentiment towards with investors increasingly looking at Europe. And indeed, exactly as Karim said, the money has been reasonably sticky with regard to the political shift we've seen in June. So that is quite remarkable, actually.
Excellent stuff. And then looking at markets, obviously we've had ECB rate cuts earlier this year. We had a few prominent elections across Europe. I mean, Vincent, what's your market outlook for European equities at the moment?
At Amundi, our outlook for European equities is cautiously optimistic, driven by different supportive factors. First and foremost, as you said, so the ECB, which is expected to continue to cut rates. So, of course, the lower borrowing costs should stimulate economic activity. A second perspective on this is related to the recent French election, resulting in a hung parliament, introducing, to be fair, a degree of political uncertainty. However, this is not necessarily a negative for the markets. History, coalition governments, and the lack of an absolute majority could actually lead to more moderate and balanced policy making, which is usually bringing some market confidence. Last but not least, economic indicators also paint positive pictures. Improvement in inflation dynamics and better than anticipated high-frequency data suggests that the European economy is on a recovery path. As I said, there are still some risk. Investors should still remain cautious with regard to risk related to geopolitics or still high borrowing costs. But as I said, reasonably cautiously optimistic with regard to European equities.
Karim, what's your take on the outlook for European equities?
We're a bit more cautious than Vincent's view in that we do think from a relative basis, the AI driver that is very much present in the top-down US equity indices is less present in European indices. But when going back to my comment around selectivity, when we go under the hood, we think there's plenty of opportunities in quote unquote the granola type stocks in the Europe. So the ones that have very good quality tilt, sectors like luxury that has also really good pricing power and decent, ability to control market share. And we also see opportunities in the European banks sector, where despite the ECB rate cut cycle beginning, to Vincent's point on borrowing costs remaining restrictive, based on history, rates are still high in Europe, and it's still good for bank profitability.
So taking a look at valuations, Aaron, coming to you, when you look at kind of the US versus European equities, Europe can seem relatively cheap. I mean, what's your take on European valuations at the moment?
Just one point to speak to what Kareem just mentioned in terms of super sectors. We're seeing exactly that from the indices. When you look at the STOXX 600, banks, healthcare, media, and technology, all double-digit performance growth year to date. The Euro STOXX 600 banks, 21%, technology, 18%. So exactly what Kareem said in terms of the super sectors are really driving the attractive valuations of European equities. Valuation specifically, we haven't seen this in a very long time, where the Euro STOXX 50 price to book is at 1.9 year to date versus US core index of 4.5. The Euro STOXX 50 price to earnings, 15.1 versus US core index at 25.8. We've not seen that in some time. European valuations being this low versus core US. It's interesting to see the dynamic between US and Europe indices when they're both core developed markets, right? These valuations have not seen this dispersion within developed markets in some time. The other side of that coin then leads to correlations. The correlation of the Euro STOXX 50 to US core index is at 0.56. Again, not seen in quite some time here within developed markets.
Great stuff. And then, Karim, coming to you, is it a good entry point for investors into European stocks at the moment?
Whilst it might be difficult to time the right entry point from a tactical market timing perspective, I think it's important to look at the valuations in another angle that is complementary to Aaron's comments, which is the discount. And European equities trade at almost a 40% discount relative to US equities, which is a historical wide. And they also trade cheap on their own history. So they trade about 10% discount relative to their long-term average. So they're cheap on a relative basis, cheap on a historical absolute basis. And yet, when you look at cheap valuations, that's only interesting if you think earnings are going to improve, because that's what would offer value. And there is a positive story on earnings for Europe. They have exited a 10-year period of stagnation in the past year. And we actually think that's one of the drivers of the sticky flows coming back year to date into this market.
Great stuff. And then, Vincent, what's your take on European valuations?
Yeah, just to echo what Karim said, when we discuss key ideas with our clients, with our ETF client, we need to look at three things. Number one is valuation. What I would probably bring on valuation is the fact that the dividend yield is actually much higher on European stocks, around 3% vis-a-vis 1.4. So if dividend yield is a measure, that can be interesting. Growth indeed is, of course, very important. We get some positive growth for this year and actually increasing for next year, 8.6 for next year. And last but not least, flows. You want to be smart in the market, but you really don't want to be alone. And the flows are actually confirming this trend. So valuation, growth, and flows, it's very hard to predict the future, of course, but that brings three key elements which we think are quite relevant when it comes to deciding on an entry point.
Excellent stuff. And then turning to sort of different European segments, Karim, what's your view on kind of the small cap versus blue chip debate in European equities, would you say?
I think there's interesting opportunities in the mid-cap space in European equities, especially growth exposures. In fact, similar to the broader comments about European equity valuations being cheaper than the US, this also applies to this growth segment of mid-cap stocks in Europe. So you can get this growth theme at a fairly attractive valuation in Europe compared to the same theme in the US. But on a general level, we still like an up in quality approach to European stocks, which tends to lend itself more to the blue chips.
Good stuff. And then Vincent, how about yourself? How do you view the different market segments?
Yeah, I mean, reasonably aligned with Karim. So both small caps and blue chips brings singular opportunities and risk, actually. So European small cap, it's a 20-year low vis-a-vis Europe large cap. So of course, it is a compelling opportunity from a value perspective. And usually we've seen that small cap have historically outperformed following the first ECB rate cut. So that might be an additional sign. On the other hand, blue chip stocks, particularly the sectors like consumer staples, healthcare, they bring stability, resilient, what we often call quality. So definitely both blue chip and small cap bring a particular attractiveness, and it might be a good case to blend them to build a resilient portfolio.
Great stuff. Aaron, turning to ESG, there are many shades of green. How do you approach ESG at STOXX?
Yeah, great. Thanks, Theo. First and foremost, here at STOXX, we're not investment managers, right? We're stewards of providing solutions to our clients who are investment managers. So we really focus on providing index solutions in the ESG space to meet specific investment objectives. What we all have seen here in the last 5 to 10 years is within investment objectives, the introduction of ESG and climate within risk and return, right? So that's really what we've been focused on. I think how we approach it, I think more recently, we've seen a lot of our clients asking for carbon climate reduction, right? So we put a lot of effort into the tools and the index design that's needed to calibrate risk return and climate reduction. You know, we could also do that in the ESG space as well. So really how we approach it, we look at it as an evolution, right? I think, there's some early entrants, early products brought to market. There's been a lot of regulatory effort in the space. This journey is one that is at its, infancy. It's starting out to really be able to provide solutions that integrate risk return and ESG or climate. And then the last point in terms of how we approach it is really going back to meeting our clients' needs and their investment client needs. It is looking at how much of a deviation from a core benchmark is needed. I think when you really look at risk return and ESG, we're really starting to enter the arena of looking at it from an investment outcome perspective versus from a singular ESG or climate lens.
Excellent stuff. And then Vincent, coming to you, how do you approach ESG at Amundi?
Yeah, maybe it can be relevant to bring some numbers, some flow data on when it comes to ESG. This year, with regard to equities, we've seen around 5 billion of net new asset in the first half of 2024. When we compare that with the actual flows into equities and so on, it's a lower number in terms of participation rates. It doesn't mean ESG is not interesting. Of course, the flows are positive. When we look a bit more into the data, what is striking is that investors are much more looking at strategies which are reasonably close from the benchmark, which often technically we call low tracking error. When it comes to Amundi, so ESG is not a product, is not a strategy, is pervasive across everything we do. So essentially, it's about product and stewardship, so engagement, proxy voting, and so forth. So it's an integral part of what we do at Amundi. When it comes to product, we aim to offer the full range from products which stay very close from the benchmark, like low tracking error, so ESG broad CTB, climate transition approaches, and at the same time, much higher conviction with SRI, PAB strategies, which bring a much higher improvement of the ESG score of the carbon or reduction of the carbon footprint. Overall, we really want to be a one-stop shop for our clients as an ESG offering.
Excellent stuff. And Karim, at BlackRock, how do you approach the many flavors of ESG?
At BlackRock, we've developed many ESG strategies because every investor is at a different point in the journey with this. And so we and has different needs around the sustainability integration. So we have two families of strategies broadly in index. The first is on sustainability focus, and the second is really on the low carbon transition focus, echoing Arun's comments earlier around an increasing demand for the lower carbon transition type exposures and solutions. And so within the sustainability focused strategies, you have the exclusion only approach with the ESG screen strategies, and then you have also the best in class approach with the SRI strategies. Then on the low carbon transition, it's a range of climate transition benchmarks, as well as also climate transition aware benchmarks, which are newer to the market.
Excellent stuff. And then finally, coming to you, Aaron, in the indexing space and around innovation, what kind of developments have we seen from you, and what kind of stuff has STOXX been working on in the indexing space?
Yeah, it's a big question here. There's a lot kind of going on in the space. But I really like to always step back and tell kind of the story of where it started, right? The Euro STOXX 50, the measurement of the European market, the STOXX 600. These indices were created in 1998, right? Investment vehicles were built on these products starting in the 2000s, right? So for a very long time, we've had the ability to capture markets in a rules-based, transparent manner. What's happened more recently, and it's kind of an old story to some degree, is the acceleration of data and technology, right? Yeah, that now we're moving into the next chapter of that story, where mass customization is what our clients are asking for and what the end investors are asking for. We're seeing a tremendous amount of appetite from the institutional community to mass customize index-based investment solutions that calibrate across the spectrums of risk, return, climate. Right, so that's really the latest development we've seen. I think what we're going to start to see, this year and beyond, is really moving into additional asset classes within that mass customization. I think there's been a lot in the press recently about alternatives, private assets, right, moving into that space in terms of capturing it in a more rules-based, transparent manner. I think there's still a lot to do in fixed income. We're seeing a lot of engagement from our clients on customizing around fixed income in the same way we've seen equity asset class customized at scale. So I think, there's a lot happening, a lot of developments. I think data and technology is kind of the buzzwords that are accelerating our space. But additional asset classes, I think, is really where we're going to start to see some excitement, specifically fixed income and mass customization.
Excellent stuff. Well, I think that's a great note to end on. So thank you all three for your time. That was very interesting.